Mastering Private Equity. Transformation via Venture Capital, Minority Investment and Buyouts. By Claudia Zeisberger. Michael Prahl Bowen White. Forward by Henry Kravis, co-chairman and co-CEO of KKR. Imagine this, you're sitting in a high-rise office, overlooking the city skyline. The hum of the financial district vibrates beneath you. Cars honk, deals are being made, and the fate of multi-million-dollar companies is decided in hushed conversations behind tinted glass doors. In your hands, you hold a document, not just any document, but a blueprint for transformation. A struggling company is on the verge of collapse, but with the right investment, the right leadership, and the right strategy, it could become the next industry giant. This is the world of private equity, a world where fortunes are made, not by chance, but by calculated risk, where investors don't just buy stocks and hope for the best. They step in, take control, and reshape the future of businesses. But let's take a step back. You might be wondering, who are these investors? How do they see opportunities where others see failures? And what separates the best from the rest? Think of it like this. Private equity is the closest thing to being a business architect. Investors don't just pour money into companies, they rebuild them from the ground up, hiring new leadership, streamlining operations, cutting inefficiencies, and sometimes taking them apart to unlock untapped value. Ever heard of brands like Burger King, Hilton Hotels, or Dell? All of them were once struggling businesses, and all of them were turned around by private equity masterminds. Private equity firms don't just invest in businesses. They fix them, grow them, and sell them for massive profits. But how? How do investors turn millions into billions? What's the secret formula behind the biggest financial powerhouses? It's not luck, it's not magic, it's a strategy, a game of high risks and even higher rewards. And today we're pulling back the curtain. We're diving deep into mastering private equity, a must-read for anyone who wants to understand how wealth is built behind closed doors. So, buckle up, because by the end of this video, you won't just know what private equity is, you'll know how the masters play the game. Chapter 1. What is private equity? Private equity is simple at its core. Buy a stake in a company, improve it, and sell it for a profit. But if were that easy, everyone would be doing it. Beneath this simplicity lies an intricate web of strategies, negotiations, and high-stakes decision-making. Picture this. A family-owned manufacturing business is struggling. Sales are declining, operations are outdated, and competitors are moving ahead. The owners are hesitant but desperate. They have two choices: watch their company slowly fade away, or bring in investors who can turn it around. Enter a private equity firm. These investors don't just write checks and walk away. They roll up their sleeves, bring in industry veterans, revamp management, modernize operations, and reposition the company for growth. They rebuild it from the inside out, sometimes keeping its core values intact, sometimes transforming it into something entirely new. Private equity firms don't invest in just any company. They look for undervalued or high-potential businesses, injecting capital, streamlining inefficiencies, and implementing aggressive growth strategies. Sometimes it's about expanding globally, taking a regional brand and turning it into an international powerhouse. Other times, it's about cutting out dead weight, shedding unprofitable divisions, renegotiating supplier contracts, and making tough decisions that public companies often avoid. And in some cases, it's about bringing a company back from the dead, rescuing a failing giant and restoring its former glory. But here's the catch: unlike stocks, PE investments aren't liquid. You can't just buy in today and sell tomorrow. These are long-term plays, 5, 10, even 15 years, where patience, strategy, and insider knowledge can mean the difference between a home run or a financial disaster. Think about this. Every legendary buyout, every startup turned unicorn, every turnaround story you've ever heard has someone behind the scenes, pulling the strings, making the calls, and orchestrating the transformation. And that is what separates the amateurs from the masters. Because in the world of private equity, the stakes aren't just high, they're everything. Chapter 2. The 3 pillars of private equity. Private equity isn't just about investing, it's about strategy, vision, and transformation. And at its core, it stands on 3 powerful pillars. Venture capital, VC, betting on the future, young entrepreneurs pitching ideas, investors nodding, a startup office buzzing with energy. Venture capital is where ideas become empires. It's the adrenaline-fueled world of startups, unicorns, and disruptive technology. Imagine a young Elon Musk pitching Tesla before electric cars were cool. A college dropout named Mark Zuckerberg working from a tiny dorm room, building what would become Facebook. Or a small group of engineers designing the first prototype of an iPhone before Apple was a household name. Like these stories all have one thing in common. They needed capital to scale. Venture capitalists take huge risks on unproven ideas, knowing that for every 10 startups they invest in, only 1 or 2 might succeed. But when they do, they change the world. Airbnb, Uber, Netflix, each of these companies started as a high-risk, high-reward gamble by early investors who saw what others didn't. VCs don't just write checks, they mentor founders, open doors to networks, and shape the very DNA of a company. But not all companies fit the VC mold. Some are already growing, but need more fuel to reach their full potential. That's where growth equity comes in. Growth equity, scaling the giants. A mid-sized company expanding operations, factories ramping up production, executives strategizing global expansion. Imagine a company that has already made it past the startup phase. It's profitable, expanding, and has a loyal customer base. But something is missing, the firepower to scale globally. That's where growth equity firms step in. They buy a stake, not a controlling share, but just enough to supercharge expansion. Think of it like adding jet fuel to a car that's already speeding down the highway. Take Spotify, a company with an amazing product, but facing massive competition from giants like Apple and Amazon. Growth equity investors helped it scale faster, reach new markets, and eventually go public. Or Slack, a workplace messaging platform that had traction but needed financial backing to grow into a billion-dollar company before it was acquired by Salesforce. Growth equity investors don't want to run the company. They let the founders and executives keep control while they provide the cash and expertise needed to reach new heights. But sometimes, control is exactly what's needed, especially when a company is struggling. And that's where the buyout specialists take over. Buyouts and leveraged buyouts, LBOs, the high-stakes game of transformation. This is the most aggressive and high-stakes form of private equity. Here, firms don't just invest in a company, they take over entirely. Imagine a well-known brand, familiar, trusted, but slowly sinking under poor management, outdated strategies, or bloated expenses. This is where buyout firms swoop in. They acquire a company, often using debt, they cut the fat, eliminating inefficiencies, restructuring operations, and bringing in new leadership. They rebuild the company from the ground up, positioning it for a massive comeback. Look at Burger King, once struggling, private equity firm 3G Capital took control, restructured the company, and transformed it into a fast food empire. Or Dell, which went private in a $24 billion buyout to escape the pressures of quarterly earnings reports and reinvent itself as a tech leader. And sometimes, a company doesn't just survive a buyout, it thrives, returning to the public markets at 10 times its original value. That's the magic of private equity. Each of these models, venture capital, growth equity, and buyouts, has its own risks and rewards, but they all follow the same golden rule: make money work smarter, not harder. Private equity isn't about buying low and selling high, it's about creating value where others see none. It's about finding the right company at the right time with the right strategy. Chapter 3: The Deal-Making Process. Every private equity deal is a carefully orchestrated process, part art, part science, and all about timing. This isn't just about throwing money at a company and hoping for the best. No, this is a game of strategy. A game where the right move at the right time can mean millions, sometimes billions of dollars in profit. Let's break it down. Step 1: Deal sourcing. The hunt for gold. It all starts with the hunt. Private equity firms don't just wait for opportunities to land on their desks. They actively seek them out. A company in distress but with strong fundamentals? That's a turnaround opportunity. A fast-growing tech startup that needs fuel to scale? That's a potential gold mine. An overlooked family-owned business with massive potential? That's an untapped treasure. But finding the right deal isn't just about numbers, it's about vision. Seeing what others miss. Recognizing the potential beneath the surface. Some of the biggest private equity success stories started with a simple question: what if this company could be something much bigger? But just because a company looks good on paper doesn't mean it's a good investment. That's where due diligence comes in. Step 2: Due diligence, the deep dive. This is where the real work begins. A single missed detail, a hidden debt, a weak management team, a pending lawsuit could turn a dream investment into a nightmare. Private equity firms leave no stone unturned. Financial analysis: is the company's balance sheet as strong as it seems? Management evaluation: can the leadership team execute the vision? Market conditions: is the industry growing or shrinking? Risks and red flags: what are the hidden dangers that could derail the investment? It's a game of detective work, where even the smallest oversight can cost millions. Once the firm is confident in the investment, it's time to determine the price. Step 3: Valuation and pricing. What's it really worth? This is where math meets psychology. Determining a company's worth isn't just about revenues and profits, it's about potential. If we invest today, how much could this company be worth in 5 years? What price are we willing to pay to maximize returns? What's the competition willing to offer? Private equity firms use a mix of financial models, industry comparisons, and negotiation tactics to land the perfect price. Get it wrong and they risk overpaying, or worse, losing the deal to a competitor. Once the price is set, it's time to structure the deal. Step 4: Structuring the deal, the power play. This is where deals are won or lost. Private equity firms rarely buy a company outright with their own money. Instead, they structure deals using a mix of equity, debt, and strategic incentives to maximize returns and minimize risk. How much control will the firm have? How will profits be split between investors? Will the company's leadership stay, or will they be replaced? This is where the real power moves happen. A well-structured deal aligns incentives, ensuring that both the investors and the management team are driven toward the same goal: growth and profitability. But even the best structured deal means nothing if the firm doesn't have an exit plan. Step 5: The exit strategy, the art of the perfect timing. Every private equity investment has one ultimate goal: the perfect exit. Selling a company at the right time, for the right price, to the right buyer is what separates good investors from legendary ones. There are multiple ways to cash out: initial public offering, IPO, taking the company public for maximum valuation; strategic sale, selling to a bigger company that wants to acquire and integrate the business; secondary buyout, selling to another private equity firm for a second wave of transformation. But here's the catch: timing is everything. Sell too early, and you leave money on the table. Sell too late, and the market may turn against you. Some of the most legendary business turnarounds in history were driven by perfectly timed exits. Tesla was once on the brink of collapse, until the right investor stepped in and fueled its rise. Hilton Hotels was struggling before a private equity buyout revitalized its global empire. Burger King was failing until private equity reinvented its entire strategy and sold it at a massive profit. Because in private equity, it's not just about buying and selling companies. It's about building them, transforming them, and knowing exactly when to make your move. Chapter 4: The secret sauce of private equity. So, what makes top private equity firms unstoppable? What separates the best from the rest? What allows them to spot opportunities others miss, make billion-dollar moves, and reshape industries from behind the scenes? It's not luck, it's not guesswork, a strategy, a way of playing the game that only a few truly master. They think long-term, playing chess. They are visionaries. They don't chase quick wins, they chase big wins. They look 5, 10, even 15 years ahead. Think about Blackstone, one of the largest private equity firms in the world. They saw the potential of real estate in the early 2000s, made strategic acquisitions, and held firm during downturns. When the market rebounded, they dominated. Or look at Apollo Global Management, which thrives on long-term plays, restructuring companies to maximize their value over decades, not days. While the rest of the market panics at short-term losses, the best PE firms play the long game, and that's why they win. Here's a secret: most of the biggest private equity deals aren't bought with cash. They're bought with other people's money. This is called leverage, and it's one of the most powerful weapons in private equity. By using debt to finance a buyout, a PE firm can multiply returns without tying up their own capital, take control of billion-dollar companies while risking only a fraction of the total cost, maximize efficiency by forcing companies to operate at peak performance. But leverage is a double-edged sword. Used recklessly, it can turn a golden deal into a financial disaster. The best PE firms know the balance: when to borrow, how much to borrow, and how to use that leverage to fuel growth rather than drown in debt. This is what made KKR's $25 billion buyout of RGR Nabisco legendary. This is what allowed 3G Capital to turn around Burger King into a global powerhouse. Here's a brutal truth about private equity. When a deal goes bad, public investors lose money. But when a private equity deal goes bad, the investors themselves take the hit. Many PE firms require their own executives to invest their personal money into deals. Why? Because when your own money is on the line, failure isn't an option. This aligns everyone's interests. Investors want maximum returns. Executives want long-term growth. Employees want a company that thrives. When everyone has skin in the game, everyone is fully committed. Mastering the art of the perfect goodbye. This is where the greatest fortunes in private equity are made: the exit. The best investors don't just buy great companies, they sell them at the perfect moment, when the market is hot and the value is at its peak. That's the difference between making millions and making billions. Look at the Carlyle Group's exit from China Pacific Insurance, netting them $4 billion after years of strategic growth. Or Blackstone selling Hilton Hotels for a record-breaking $14 billion profit after restructuring and expansion. They don't get greedy. They don't hold on too long. They strike when the iron is hottest. Because in private equity, timing isn't just everything, it's the only thing. Chapter 5: The future of private equity. Private equity is evolving faster than ever. The old ways of deal-making, handshakes, gut feelings, and drawn-out negotiations are being replaced by cutting-edge technology, sustainability-focused investing, and new direct investment strategies that are rewriting the rules of the game. What once took months of due diligence can now be done in days. What was once high risk can now be calculated with precision. Let's dive into the future of private equity. A future shaped by AI, sustainability, and direct control over investments. 1. Tech-driven investing. AI is changing the game. In the past, private equity investing was a game of experience, intuition, and months of research. AI and big data are reshaping everything. AI-powered algorithms can scan millions of data points, from financial statements to CEO interviews, to identify undervalued companies with hidden potential. Due diligence that once took 6 months, AI can do it in weeks, analyzing risk, market conditions, and competitive landscapes with unparalleled accuracy. Predictive analytics can forecast which industries will boom before they do, giving investors the edge they never had before. Imagine a machine learning system that predicts the next Tesla or Amazon before Wall Street even notices. This isn't science fiction. It's happening right now. Firms like Blackstone, Apollo, and KKR are already using AI-driven investing models to identify undervalued assets before competitors, predict M&A activity based on real-time market movements. The result? Smarter, faster, and more profitable deals. But technology isn't the only thing shaping the future. There's a bigger revolution happening, one that's not just about profits, but impact. ESG and sustainable investing. Profits with a purpose. Once upon a time, private equity was all about one thing: returns. But today, the biggest firms are asking a different question. How can we make money and make a difference? ESG, environmental, social, and governance investing, is no longer a trend. It's a necessity. Climate change is real, and investors know it. PE firms are pouring billions into renewable energy, electric vehicles, and carbon-neutral businesses because they know the future is green. Consumers are demanding responsibility. Brands that ignore sustainability, they risk losing customers and market share. Regulators are stepping in. Governments worldwide are rewarding businesses that focus on clean energy, ethical labor, and long-term sustainability. This is why firms like TPG's Rise Fund and Generation Investment Management, co-founded by Al Gore, are leading the charge, investing in companies that deliver both impact and high returns. But there's one more major shift happening in private equity, and it's putting more power in the hands of individual investors than ever before. Direct and co-investments, cutting out the middleman. For decades, private equity was controlled by institutional investors and massive funds. But not anymore. The rise of direct investing and co-investments means that investors no longer have to rely on traditional PE firms to access high-quality deals. High-net-worth individuals and family offices are now going direct, partnering with companies themselves and bypassing traditional PE funds. Institutional investors are co-investing alongside PE firms, reducing fees and increasing their control over the deals they back. Tech platforms are democratizing access to private equity, allowing more investors to participate in once-exclusive deals. This means more flexibility, lower fees, and potentially higher returns. Imagine being an investor and getting direct access to the next SpaceX, Stripe, or Airbnb before they go public. That's exactly what's happening. Large institutions like Canada Pension Plan Investment Board, CPPIB, and sovereign wealth funds are cutting out middlemen and going direct into private equity deals. The future of private equity is here. The old ways of private equity, slow, exclusive, and risk-heavy, are fading fast. The future belongs to those who adapt, evolve, and embrace the revolution happening right now. Are you watching from the sidelines? Or are you getting in the game? At the end of the day, mastering private equity isn't just about finance, it's about power. If you've ever dreamed of building wealth, of scaling businesses, of investing like the pros, this book is your starting point. It's not just about learning, it's about mastering the game. Hit like and subscribe if you found this video insightful. Drop a comment below. Would you invest in private equity? What's stopping you? And most importantly, start mastering the game today. Until next time, keep investing, keep learning, and keep chasing success.